Hello, and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown, hopefully without the technical problems that we encountered yesterday that's essentially caused the delay to this morning.
Yes, I was going to say, very good morning to you, mate. A very happy Friday. I was hoping you didn't mention the technical issues. It feels like you're tempting fate now. So, keep fingers and toes crossed that everything works.
Yeah, indeed. And it's certainly been a packed week. It's difficult to know where to start. Obviously, there's an awful lot of chatter about AI valuations yet again. We're not going to recycle those arguments. They're pretty much well known. Bit of volatility. US markets off their highs, trending a little bit lower. UK markets, on the other hand, bearing up reasonably well. And essentially, I think what we're seeing is a little bit of choppiness ahead of the run up to Thanksgiving and potentially towards year end.
Yeah, that's very much what it feels like. I mean, it's been a bit of a strange week, in all honesty, because as you said, there's a lot going on. Markets, it's been very much sort of give with one hand, take with the other. We'll rally on a Tuesday, we'll sell off on the Wednesday, we'll try and get it back on the Thursday, and then we'll sell off on the Friday.
And ultimately, channeling Craig David there.
He could remix that. But ultimately, we're basically where we started the week, to be completely honest with you. I don't think these AI concerns are particularly new. They've been lingering for quite a while. But as you say, we are getting into that sort of almost that year-end period already. We've had that conversation before about how year-end could be early in 2025, and maybe that's just limiting the conviction among market participants to step in and buy the dip, so to speak.
Yeah, and that's before we even start talking about the Bank of England yesterday. Obviously the speech by Rachel Reeves earlier this week.
That was just bizarre, to be honest.
It was a bit strange, and I have to say some of my comments got me into a little bit of trouble with a certain subset of anyway, we won't go into that. Let's just say that I was called a lot of names, but nothing compared to some of the names I was called on the trading floor all those years ago. But hey ho.
Anyway, in any case, names that we can't repeat on a podcast. That's a given.
No, indeed not. I mean, I've been called far worse. So water off a duck's back. Anyway, let's get into the risk warning, and then we can crack on because we've got quite a bit to get through. So
indeed,
let's go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so as I say, what's been driving markets this week? Weakness in tech. I think that's understandable given the run-up that we've seen thus far. We've had some disappointment over recent numbers from AMD and Super Microcomputer, and it's likely that we're probably going to see an awful lot more of this volatility as we head into the break. But we're not going to dwell on that, because I think the big topic for this week is being essentially the Bank of England. And also, the news last night that ITV could be receiving a bid for its media and entertainment business, which is a bit of a strange one. So we're going to talk about that. We're also going to talk about the latest results from Amazon and Apple, which seem, as you said, just prior to us turning the camera on and the microphone on a decade ago. It was only last Thursday night, not last Thursday night, but just over a week ago. So we're going to look at them. And then we'll look at this week's numbers from the retail sector, Associated British Foods, easy for me to say, who own Primark. There's an interesting story about that. Sainsbury's, Marks and Spencer's, Witherspoons, as well as BP, Diageo and AstraZeneca, before moving on to next week, where we'll look forward to the third quarter GDP numbers from the UK, as well as the latest results from Vodafone and Rolls-Royce. So Where should we start, Michael? Should we start with the Bank of England and obviously the speech earlier this week by our esteemed Chancellor Rachel Reeves?
Yeah,
Discuss.
let's get the BOE out of the way first of all, shall we? Because although they held bank rates steady at 4% in line with expectations, I think it was a dovish hold, you would argue. Not only with the vote being the narrowest possible margin on the MPC, a 5-4 split with 4 dissenting in favour of a 25 basis point cut yesterday, but also with that change to the guidance where they've now removed reference to gradual and careful easing, and instead they're sort of more explicitly saying that if the disinflationary process continues, then bank rate will likely to continue to come down gradually. And it does seem very much as if Bailey and his colleagues have opened the door to delivering a rate reduction in December. By that point, you're going to have had another 2 CPI figures. The only thing I would say is the governor sat there yesterday talking about how they expect 3.8% CPI in September to be the peak. I do worry that he may have made himself a bit of a hostage to fortune on that front now.
I was looking. There was also a new development as well in terms of the actual policy decision, because we had all of the members, all the MPC members, basically outline their reasonings for basically why they voted the way that they did. Now, I think that's a good thing. Personally, I mean, you may disagree.
No, I do disagree, actually.
Well, you mean, yeah, but I think what it does is it gives, I think, us a much more clear idea of whether or not each member is likely to either double down on their calls for a rate cut or basically dig their heels in. And this paragraph from Megan Green really struck me. I continue to believe inflation risks are to the upside and worry that the disinflationary process has slowed. Now, she stands out from all the people who voted to keep rates unchanged, from, say, for example, Claire Lombardelli, Andrew Bailey, Catherine Mann and Hugh Pill, who believe that disinflation isn't necessarily a done deal. They're worried about sticky inflation. They're not worried about the risks of being to the upside. It's really about, it's at 3.8%. It's not going to come down quickly. That's what they're worried about, because it's been 3.8% for the past 3 months. And it could well stay at 3.8% for the next 3 months. What does the Bank of England do then?
Well, I mean, you would argue that they would stand pat. I mean, Governor Bailey was saying that they want to see more evidence of disinflation in his press conference yesterday. But I think the BOE is very. Oh, I agree. It makes complete sense. You know, you've had one good CPI report. You need 2 or 3 more before you can rest on your laurels. But yeah, I think, again, it just speaks to that dispersion of views among MPC policymakers at this point. You've got 4 who, as you say, are worried about whether inflation risk tilts the upside, but also worried about the slow journey back towards 2%. You've got another 4 who are clearly worried about the margin of slack that is emerging in the labour market. And then you've got the governor sort of sat somewhere in the middle. I guess the one good thing about all of this is at least we can't accuse the MPC of groupthink anymore, because it was actually September 2021 the last time that all 9 policymakers voted in the same direction. So in a way, I suppose it's refreshing, but when you're a strategist trying to work out what the hell they're going to do next, it does make things rather difficult.
Well, that's why they pay you the big bucks, mate. That's what we're paid to do,
Do
right?
No,
but
yes,
I mean,
that is what we're paid to do.
That's what we're paid to do, right? So, for me, I think it's a challenge, because ultimately how am I going to call this? And for me, people have said the casting vote is Andrew Bailey. When I look at those remarks, he is the one that ultimately could essentially deliver a rate cut in December. If he is persuaded that after those next 2 CPI reports that inflation is slowing down, not coming down, slowing down, then we could well see a December rate cut. But if it stays at 3.8% for the next 2 months, what's the case for a rate cut?
Yeah, I don't think there will be one at that point. And you're absolutely right. That is the correct framing. Andrew Bailey, as the governor, holds the casting vote. There are 4 that will pretty much nailed on to vote unchanged. There are 4 that are pretty much nailed on to vote for a cut, whatever happens. It's down to Bailey what happens next. And obviously, a lot of what happens next is going to hinge on what Rachel Reeves has to announce in the budget in a little under 3 weeks' time.
Which is why they were entirely correct to hold rates where they were.
Yes, absolutely, because of course the bank can only make policy based on the announced government policy of the day, and the budget has not yet been announced, although the number of leaks we're getting, the number of rumours we're getting, we're even getting the Chancellor standing up on Tuesday morning delivering a press conference trying to explain, the framing around the budget and all the rest of it. It's pretty clear, I think, at this point that the direction of travel remains towards significant tax hikes and actually towards an income tax hike at this point.
What's the point of that speech? Because I'm looking at gilt yields, and the 10 years now back on the highs. Well, it's back at the highs for the last 2 to 3 weeks. So if the point of that speech was to drive yields down, it hasn't really worked. And so I mean, essentially, what was the point of it?
I don't know. I genuinely don't know. And we were sat there in the office on Tuesday morning watching the speech, and we're all sort of scratching our heads going, who is this aimed at and what is the point? The Chancellor stands up at 8:10 in the morning in Downing Street 3 weeks before the budget. It, as you say, it clearly wasn't aimed at financial markets, not only because they haven't moved, but also because there wasn't actually much sort of meat on the bones of what she was saying. There was no substance to it, and there can't be. We're so close to the budget. I don't think it was aimed at quote-unquote Joe Public because, well, one, they're probably at work at 8:10 in the morning, and if they're not, there was nothing in the speech that... Exactly, and there was nothing in the speech that we haven't heard anyway. And was it aimed at Labour MPs? Well, you can do that behind closed doors. You don't need to go on primetime television to do that. So all very, very bizarre, to be completely honest with you. I would love to know who's been advising her on that front.
Well, when you get pretty much everyone on the mainstream press sort of asking the same question, even the press that's friendly to the Labour Party, you do sort of have to ask the question,
what was the point?
what was the point? Because ultimately you seem to have upset everybody and just basically created the environment for an awful lot of noise, hyperbole and insults, essentially.
Yeah, well, in your case, yes. But you're right, noise is off the scale. I think it was John Stepek over at Bloomberg wrote in one of his columns this week, by his maths, so if it's wrong, go and complain to him, please. There have been rumours or trial balloons of changes to over 100 different taxes at this point. It's frankly ridiculous. And this is with 3 weeks still to run until the Chancellor stands up in the Commons. This is only going to get worse. The noise is only going to increase over that time period.
Which I think says everything, because when you actually look at some of the numbers from retailers this week, an awful lot of them have said that people just aren't spending. People are cautious, and it's not hard to see why when the press is replete with warnings about what the budget might bring, and people are concerned A, about their jobs, B, about price rises, and C, whether or not and see as to how much money they can spend in the lead up to Christmas, and then how they're going to pay it back in the new year.
Yeah, exactly that. And, with this degree of uncertainty, it's natural people are going to demonstrate a bit of restraint and tighten their belts.
Indeed. Okay, well, broader UK economy is actually not looking too bad, given all of this uncertainty.
The PMIs were actually all right, weren't they?
Yeah, they were okay. And again, this ties back to, I think, previous comments or previous conversations that we've had, that some of the macro data actually looks okay-ish, but some of the survey data does suggest that, maybe the economy is probably not as strong as perhaps some of the macro data suggests that it is. And obviously the retailers are generally bringing up some fairly solid numbers. I think a lot of that has been probably down to the hot summer, which I think has helped. And people have gone out to think, well, the economic environment may look pretty miserable, but I'm going to at least try and enjoy the good weather.
Yeah, but also at the same time, and again, we've said this before, where you're getting decent economic data releases come in, but at the same time, you're looking at it going, well, actually, in 3 months' time or 3 weeks' time, whatever it is, things are going to look very, very different indeed. because of the budget. We don't know where things are going to stand. Is this relatively resilient consumer spending going to continue? Is the labour market going to roll over more rapidly? Is consumption going to slow significantly? All of these sort of questions where ultimately you have to take the data with a little bit of a pinch of salt, because the outlook is likely to be turned on its head in the very near future.
I think there is concern about weakness. We're not seeing it reflected in gilts at the moment. We're not seeing it reflected in stock markets, but I think we're certainly seeing it reflected in the value of the pound. Obviously, the rate hold has, I think, helped put a floor under the pound at 130 against the dollar, 7-month lows, but it's at 3-year lows against the euro. So that's got to be a concern for the Bank of England, because UK being what I would term a net importer, a weak currency is going to make it much more difficult to return inflation to target.
Exactly. The weaker the pound is, the more inflation you're importing into the country. And actually, going back to who was Rachel Reeves' speech aimed at, well, the only thing that did react was sterling, to be completely honest with you. As you said, falling to its lowest level since April, just north of that 130 mark. And, again, that is something that you would expect will have to factor into the Bank of England's thinking. And I think the way I was sort of framing that move was one where the market is effectively repricing a much, much slower UK growth outlook compared to its peers, given the potential for significant consumption, personal tax hikes.
Well, the IMF has already warned about that last month. So, that shouldn't be a surprise. I'm just surprised it hasn't really been reflected in gilt markets yet. But again, we'll see.
Yeah, and also there's a fiscal premium in gilts as well over, this doom loop continuing. So, there's a few moving parts there, I think.
Okay, let's move on because we've got a lot to cover. ITV. I'm going to skip to that because they released their third quarter numbers this week, and they're a bit of a mixed bag, shall we say. They did issue a guidance warning on their media and entertainment business. They said that the budget uncertainty meant that they were revising down their guidance for Q4, and that expected that advertising revenues would fall by 9% in the final quarter. And that's a hefty fall. But last night, there was a story broken, I think, on Bloomberg or the FT, one or the other, that Comcast was looking to buy, no, not the ITV Studios business, which has been subject of an awful lot of takeover speculation over the course of the past few years, the media and entertainment business. Well, to paraphrase a well-known meme, it's a bold strategy, dude. Let's see if it pays off.
Is it bold or is it foolish? Because I'm sort of scratching my head as to, I think that's probably better, the air quotes for our listeners out there.
Bold.
If we've discussed ITV before, and the studios arm has been performing well. We know that. The media and entertainment arm has not been performing particularly well. So unless Sky or Comcast, I should say, are coming in from a position of relative strength, going, actually, we see value here. We appreciate the business is struggling. We can pick it up at a knockdown price and try and turn things around. That's the only real case you can imagine for making that offer. Otherwise, I'd like to know what they're drinking over in Comcast HQ, and can I have some, please?
Yeah, I'm looking at the revenue breakdown between the two, and obviously the media and entertainment business still produces the lion's share of the revenue, but not by that much. Entertainment revenue down 5%.
So the direction of travel, isn't it, as well?
Yeah, absolutely. It's £1.44 billion for ITV Studio, entertainment and revenue down 5% at 1.44 billion year to date.
Yeah.
Total ITV Studios revenue 1.35 billion year to date. That's up 11%. So you can see, the studios is going in the direction that essentially it's going to be the main contributor
in relatively short order.
In fairly short order. I mean, it's been going that way for quite some time now, and ultimately it is the crown jewels. I think there was some speculation that Netflix might be interested in the studios business. Because I
Well,
know
I
there
think
was some
Netflix
talk that they were looking at Warner Brothers Discovery as well.
Yeah, I was going to say they might be tied up with that one for a period of time now. But yeah, I guess that is then going to be the next question, isn't it? If this, it is only an offer at this stage, so we may be jumping the gun a little bit. But if this were to go through, what then happens to the studio side? Does that then get snapped up in relatively short order as well? You would imagine that that's a bit of a sitting duck at that point.
Yeah, I mean, given the valuation, but I think if you then you offload the struggling advertising business, and it's not just the media, it's not just the advertising business, it's ITVX, it's all of it's the streaming side of the business as well. Does suddenly ITV Studios become a much more attractive proposition and be much more attractively valued if you shake off the media and entertainment side of the business? Does ITV Studios suddenly have a much higher desirable valuation?
Yeah, I mean, there's certainly the potential for that because it won't be hamstrung and held back by the underperforming side of the business, potentially.
Yeah, it's an interesting one. I mean, the share's gone from 68p yesterday. They're now around about 77p. They did briefly pop above 80, but they're still well above the highs that we saw back in August when they were July, when they were around 88p. So, as you say, there's no guarantee that Comcast will pursue and make a bid. And even if they do, I'll be very interested to understand how much they're prepared to pay, because I don't think that the Sky acquisition has potentially gone as they thought it might.
No, I don't think it has either. And then, of course, the other thing that we haven't touched on is whether there might be any competition concerns involved as well.
Well,
which you certainly can't rule out.
Yeah, I don't think you can rule that out. So that's an interesting one. I'll be interested to see how it pans out. Very surprised that they're after the media and entertainment business. I would have been less surprised if it had been the studios business, but it does raise questions that if that deal does go through, what does that mean for the studios business?
Yeah, exactly. So certainly one to watch.
Absolutely. Okay, so let's get back on track. You may or may not remember that Amazon and Apple actually reported their latest numbers last Thursday night. Not last night, but the Thursday before. And by and large, they were both fairly decent sets of numbers. Amazon's share price shot up quite substantially. Amazon Web Services saw a very strong quarter with net sales of $33 billion, an increase of 20% from the previous year. That's Amazon Web Services. The actual overall business comfortably beat its upper boundary of forecast of $180 billion, an increase of 13%. And for Q4, they were equally bullish. So the shares have shot up for Amazon after trading sideways for a good part of the last few years. So, I mean, looking at that, record highs for the Amazon share price. So despite all of this talk about tech bubbles and what have you, Amazon shares shot up. Apple shares made a new record high as well and haven't really come off significantly from that. So I think context is everything.
Yeah, absolutely. And I mean, just in terms of those earnings themselves, I mean, as you covered, Amazon basically delivering beats on absolutely everything, no matter where you look. There's really nothing in that earnings report that you can complain too much about. Apple, the market reaction, if I can think back that far, which is a challenge these days, they were actually sold in reaction to that earnings report because their Greater China revenue was a bit softer than expected. But the company very quickly came out and clarified that was due to a delay in production and release of the iPhone Air. And they don't expect that to be a particularly significant headwind in the quarters ahead. So that's, again, Apple can shrug that off relatively easily. But I know we discussed at the time, one of the key takeaways from the Apple earnings report is that over a quarter of their revenue now comes from their services business, which is something that they've been seeking to diversify towards for quite some time now. And again, it makes that revenue much more diversified and much more reliable as well, because they're not just reliant on an upgrade cycle anymore.
Yeah, Q4 revenue, $102.5 billion. Services, another record high of $28.75 billion. But this iPhone revenue was really surprising, I think, because that rose to $49.02 billion, which was an increase of $2.8 billion from the same quarter a year ago. So maybe this new iPhone is perhaps going to deliver further as we head into what generally tends to be, I think, Apple's best quarter, which
Yeah,
is
the
its
holiday
Q1
quarter's
leading.
always
Yeah, the
strong.
holiday quarter. Yeah,
Yeah.
Q1. I mean, I'm looking at what Apple is expecting for this quarter. Q1 revenue growth of 10 to 12%.
It's crazy, isn't it?
I know. iPhone sales expected to see double-digit growth.
Yeah.
Double-digit growth.
And this is just also, this is double-digit growth on overall revenues that are well over 100 billion anyway. These are numbers that it's incredibly difficult to actually put into context.
I mean, basically, iPhone revenue is basically half their, almost half their quarterly revenue. It's $49 billion in Q4. So double-digit growth in that. You're looking at, a very significant gain. Maybe 120, 130 billion dollars for Q1.
Yeah, certainly if you have a strong holiday season in there as well.
Yeah. Which sort of defies a lot of the doom and gloom about, tech being a little bit overvalued. $4 trillion, though. I mean, I got to say, that's hefty. $4 trillion company. How many of them are there now?
I think there's 3, isn't there? I think we're still
Nvidia
are 5,
Microsoft,
and Apple.
Nvidia, Microsoft, and Apple.
I think that's right. Yeah.
No one
Pretty
else.
sure that's right. No.
Yeah.
Well, not yet. Give it time.
Possibly. Okay, so that's those. Let's move on from that, because I think the weakness that we've seen in both Apple and Amazon this week, it still needs to be set in the context of the gains that we saw last week. So
yeah, absolutely. Zoom out a little bit.
Zoom out a little bit. UK retail. It's been a big week for UK retail. We've had numbers from Associated British Foods, full year numbers there. We've had first half numbers from Sainsbury's, and we've also had numbers from JD Witherspoon and Marks and Spencer's. Where should we start?
Well, should we start with Sainsbury's, because we can start on an optimistic note?
Yeah, absolutely. Let's do that. Sales growth of 5.3%, grocery sales. General merchandising and clothing saw sales growth of 3.3%, and Argos saw sales growth of 2.3% as well, which is very welcome, because Argos has been, I think, what I would call a little bit of a it's always been a little bit of a drag, if you like, on the business.
Yes.
But it's finally, after an awful lot of pain and effort in integrating Argos into the Sainsbury's business model, there does appear to be now signs that it's gaining traction and actually contributing to the bottom line rather than being a drag on it.
Yes, absolutely. And as you say, now that integration seems to be firing on all cylinders. And also, of course, the potential spin-off of Argos that was being rumoured a couple of months ago, that all seems to have gone rather quiet. And as we were discussing before we went on air, rightly so. Why would you spend all that time getting the company integrated? It just starts to be a positive contributor, and then you go, no, let's get rid of it.
It seems utterly bizarre, that story at the time. Because I remember when Sainsbury's bought Argos, and I thought at the time, maybe you're overpaying for it. And to be fair, they have struggled to integrate the business into their business model. But now you've got all these Argos outlets inside the stores, and they've got rid of most of the bigger the standalones. Exactly. Why would you then, after sinking all that money into integrating Argos into the business model, would you then look to basically flog it off?
Yeah, it does strike me as bizarre. So I think investors should be reassured by the fact that that hasn't happened, and actually reassured by the earnings at large. I don't think there's really anything that can be complained about there. I mean, clearly there are still price is still the main point of competition, but that's always going to be the case if we're being completely honest with you. And a 5% increase in pre-tax profit, you can't really complain too much about that.
No, you can't, nor a special dividend either.
Exactly.
150 million pound share buyback, 5% increase in the dividend to 4.1%. I mean, statutory profits were up 117%. Of course, that's going to get the usual suspects complaining about profiteering. But when you actually look into it, a lot of that profit increase was driven by proceeds of its sale of Sainsbury's Bank to NatWest.
Yes. And when you take that out, margins have been relatively constant, which is the same for the majority of retailers.
Yeah, exactly. And if you think supermarkets are profiteering, you clearly haven't looked at food prices in countries like France, Germany, Ireland, or the US.
Yeah, exactly. Higher food prices is not a UK specific phenomenon.
No, it's not. And the only reason that they're higher here in terms of the CPI number is energy prices.
Yes,
but
and
also
labour as well.
And labour costs. So
yeah, I was going to say, I mean Labour costs, not the Labour Party, before anyone tries to have a moan at me for that one.
I think they're pretty interchangeable.
It does feel that. Let's move on. We're going to get ourselves in trouble.
Oh, well, whatever. So Sainsbury's shares, fairly decent run up, and they've popped up to their highest levels since 2014.
Yeah.
360. So that's a decent set of numbers. Associated British Foods, otherwise known as Primark.
Well, maybe Primark, not for much longer.
Well, that's the thing. Why would you spin off the Primark business?
Well,
make the argument, Michael, because I can't see the rationale for it unless you keep a significant stake in it.
Yeah, I was going to say, I fear you may have actually just made my argument for me there. There is an argument, which is that ABF are a conglomerate. They've got a collection of goodness only knows how many different businesses, food businesses, commodity businesses, sugar businesses. Primark is in the mix as well. Now, the traditional wisdom would say, well, that's actually a good thing because it means that they have diversified revenue streams. When one part of the business is underperforming, other parts of the business can make up for that, and it's not necessarily as concentrated in a sector as you would often see. Now, of course,
helped them during COVID.
Massively helped them during COVID when Primark sales effectively went to zero. Now, the counterpoint to that would be market participants, investors, analysts, whoever they may be, saying, actually, we would find it easier to value the business if it concentrated on one thing, if it concentrated on food, if it concentrated on commodities, if it concentrated on retailing, whatever it may be. Would that generate a better overall valuation for the collection of businesses if they were listed separately? There's only one way to find out that answer, and that is to go through with it and to list them. But if you're sat there as an ABF shareholder or on the ABF board, I completely agree with you, which is that Primark is one of your prized assets. If you spin it off, you need to retain a significant stake in it. Otherwise, you are effectively setting fire to pound notes.
It's a key growth business. They're expanding in the US. US sales contributed 4% to the growth numbers. So that expansion in the US is a huge market. Now, if you're looking for investors to basically help you with the capex of that, then yeah, fine. But for me, there's no rational case for selling off one of what is your best performing businesses just to satisfy some idea that you can unlock value to the detriment of the rest of the business.
Which is why, if you were to do it and retain a stake, that would make some degree of sense. It would also slightly defeat the point of spinning it off in the first place, but it would make some degree of sense. If you were to just basically get rid of it, then yeah, I agree with you. That would be a real head scratcher. And actually, you would expect that would be reflected poorly in the share price of ABF if they went down that route.
And I think this idea that somehow splitting off businesses into the separate components unlocks value, it's just a load of old nonsense. Because if you look at Marks and Spencer's, for example, and let's move on to that, they've got a very strong food business.
Very strong.
And for a long time, that helped keep the general merchandising business afloat. I mean, I've been following Marks and Spencer's pretty much for my entire analysis career. They had so many turnaround plans since 2007, 2008, and each one basically fell flat on its face until this one.
And it's worked.
Which was started under Steve Rowe and has been taken and has been basically built upon by Stuart Machin. And, I look at Marks and Spencer's and I see now a UK retailer that's delivering not only on food, but also on merchandising. General merchandising, clothing.
Yeah, absolutely. And as you say, that is a significant change for Marks and Spencer's, because obviously the food business has been underpinning things for so long that now the rest of the business is coming along with it is really, really pleasing to see. The only issue, for want of a better word, is that, of course, the results we had this week were clouded by the cyber attack that knocked the online purchases out for a number of months. But we knew that was going to happen. That's not a surprise. We knew that was going to basically wipe out their profits in the first half of the year, which is what it did. And actually, looking at the fundamentals of the business, things are certainly moving in the right direction now that they hopefully are moving past those issues.
Yeah, I mean, this impact was clearly felt more in the general merchandising part of the business. Sales declined 16.4%. A reduction in margins, or adjusted operating profit there slipped to £46.1 million, and 42.9% decline in online sales. Well, yeah, I mean, of course, absolutely.
If you turn online sales off, they're not going to go up, are they? Let's be completely honest about that. Yeah,
store sales fell 3.4%. Okay, so that and we know what happened. That benefited Next.
Yeah, exactly. And again, that's a story we know about.
Yeah. Food sales, on the other hand, rose 7.8%. And I was thinking, how does that work? But I think a lot of the reason for that was because obviously food sales has very limited shelf life.
Yeah.
They sold it off cheap.
Yeah.
They just basically looked to offload inventory before it's spoiled. And that's why margins there collapsed, essentially, and we saw operating profits there fall 59%.
Yeah, and that's actually a really... Oh, sorry, go on.
No, go on.
No, I was going to say that's actually a really good point, because we know that the cyber attack affected the online side of the business. It also affected all of their logistics and their supply chain and all the rest of it. So as you rightly say, you've got all of this stock that is not being managed in the way it would usually be managed. What do? You either get rid of it at a profit, a small profit, but a profit, or you just throw it in the bin. And obviously they made the right option, which is just to throw stuff out at knockdown prices.
This is what I can't get my head round, Michael.
There's
a 22.5% increase in revenue.
Yeah, I didn't know where that came from either, to be honest. But again, I guess it speaks to the broader resilience of the firm and of the brand.
But I think also, if you're just basically offloading stock because you can't store it, then you're going to get a revenue boost.
Yeah, those yellow stickers are going a long way, aren't they?
Yeah. Notable increase in revenues. The retailer also had to deal with an increase in costs in the form of the extended producer responsibility packaging levy. God, that's a mouthful.
It is a mouthful, and it's something we've discussed before. It's also a pain for companies to be implementing that, and also an incredible cost for them, as you rightly just said.
Added over £50 million to deal with this. M&S said it's looking to cut another £600 million in costs to mitigate these increases in the form of cutting loss-making lines and improving logistics with more boxed automation, whatever that means.
Well, they seem to know what it means, and they believe that that's going to drive efficiencies. So we'll see whether it works. I think
automation means that less human beings.
Job losses, ultimately. Yeah.
Yeah, exactly that. So that's
however
Marks
you dress
and Spencer's. Yeah, exactly that. Right, done that. Witherspoons.
Yes.
I always enjoy reading the RNS announcements from JD Witherspoons, because you can always rely on Tim Martin to, take a pop at the government.
Yes, absolutely. And to be fair, rightly so, because as we've mentioned, Wetherspoons is a real success story in the UK, and they are being absolutely clobbered, not only by changes to national insurance, etc., but also the pet topic of Tim Martin, which is why it's so much more expensive to be buying alcohol in a pub than it is in a supermarket.
Well, we know the answer to that, don't we? VAT.
Indeed, and he is continuing to bang that drum, and why wouldn't he? But I don't think he's going to get anywhere, certainly ahead of the budget later this month. And of course, they were relatively cautious in terms of the outlook in reflection of that budget, which makes sense. But they are continuing to expand. I think they're expanding in a a cautiously optimistic manner. Those new pubs that they've been opening in London, like-for-like sales are moving in the right direction. Total sales have been moving in the right direction. They are still a very, very robust and resilient business on the whole.
Yeah, total sales rose 4.2%. 4 new pubs opened, including 2 in London, 1 at London Bridge Station. Have you been to that one?
I have been to that one, actually, yeah.
And the Paddington Basin.
You knew what I was going to say in response to that.
but anyway, yeah. So anyway, Tim Martin's taking a pot shot.
The 4.2% sales increase did not come from me. Let me put it that way.
Yeah, indeed. One example that Tim Martin used was that pubs have lost 50% of the beer volumes to supermarkets since the year 2000.
I mean,
so in
that's
25
shocking,
years, they've lost 50%. I mean, it also explains why there's so many fewer pubs now than there were, 25 years ago. I mean, I can remember going back to my old stomping grounds back in Croydon only a few years ago. And a number of the pubs that I used to drink in when I was in my 20s and 30s, they're no longer there.
Yeah,
they're gone.
No,
they're gone.
And that is not going to change.
They're either Tesco's or Sainsbury's, sort of mini stores.
Yeah,
and
actually, it is a real shame. But also, I think sadly, that is a trajectory that is not really going to change at this point. If consumer habits have shifted so much, as that stat proves, people are drinking at home. People are buying beers in the supermarket, not in the pub. That is the unfortunate reality of the situation, I think.
Yeah, I mean, I think also the culture nowadays is slightly different to when we were in 20s and 30s. I think the drinking culture, there was more of a drinking culture, I think.
Yeah.
There is now from people our age, but people of the same age of when we were then.
No, you're absolutely right. But yeah, as you say, sort of cautious optimism from Wetherspoons in terms of their guidance. So we'll see how that evolves.
Okay, BP.
Yes.
A fairly positive reaction to the results. Shares up around 450, still not back at the peaks of earlier this year. I'm not quite sure what to make of them. The buyback was maintained at £750 million. Yeah, the numbers. I mean, we follow a number of people on social media X who, I'm not going to mention any names. They are BP fans, and I can sort of see that. I can see the rationale behind why they think that BP is undervalued. I just don't see it with the current management.
No, and I would agree with that. And I think the results that we got were just a bit. There's not unremarkable, I guess, is one way to put it. Yeah, I mean, they could have been a lot worse. Let's be completely honest with you. The fact that profits remained flat despite crude prices falling 15-20% in the quarter is noteworthy. But also at the same time, it's not blowing the lights out, is it?
No. And I think that's my concern. I think it's not so much the fact that profits are holding up fairly well. Divestments in Q2 were a mere $28 million. Right? Now, the BP have got a target of getting their net debt down to between $14 and $18 billion by the end of 2027. Their net debt's gone up in the last 12 months. It's gone up from 24.2 billion to 26 billion. And even accounting for the fact that they've sold off or agreed a deal to sell off their stakes in US Permian and Eagle Ford shale assets, that's $1.5 billion. Well, that's not going to butter many parsnips.
Well, I was going to say it's not even a drop in the ocean, is it? Realistically,
no. And yet so net debt is 26 billion. So by the end of 2027, they want to get it down to 14 to 18. What are they going to sell? Are they going to get that 12 billion? More importantly, are they going to improve their operational cash flow from the new assets that they've announced in a manner that will allow them to meet that target, but at the same time maintain the buyback? I'm sceptical.
I would be sceptical as well. And I know BP said that there's $3 billion worth of payments that they're due before the end of the year, and that will bring the debt pile down a little bit. But again, a little bit sceptical on that front. I think the bigger issue is, as we were discussing off air before we came on, is that everyone in the market knows they're a seller. So the price they achieve for these assets is going to be nowhere near a sort of fair market value for the assets that they're disposing of. And I think that is a significant problem for the company. The other thing that I continue to take issue with is the buyback. And I know why they're continuing to do it, because the market expects them to do a buyback. But when your priority is to bring down your net debt pile, why don't you use some of those spare funds to bring down that pile as opposed to buying your own shares back? That strikes me as a relatively straightforward idea.
Well, they're spending $3 billion a year on buybacks.
Yeah, and they're due $3 billion in payments by the end of the year. So you could double the amount that they're going to bring down their net debt pile by the end of the year if you just can the buyback.
Indeed.
And in terms of sustainability, that will put them on a much, much better footing, I think.
And I think we've seen, sometimes the buyback, suspending a buyback is not a popular decision. We saw that in the case of HSBC last month, when they basically suspended their buyback to purchase the rest of Hang Seng Bank that they didn't already know. The shares are now higher from when they announced that decision. So suspending a buyback doesn't necessarily need to be a long-term negative if it's putting a business on a slightly more sustainable footing. Now, you can question as much as you like about the motives for HSBC doing what it did, but the knee-jerk reaction was negative. But ultimately, it hasn't dented the share price at all in the longer term. And I think BP doing something similar wouldn't, in the long term, be such a big negative.
No, I would fully agree with you on that. I think if it's framed correctly, then it could actually be a positive for the longer term performance.
Okay, right. Two more. Let's talk about Diageo, because I think shareholders are going to need an even stiffer drink after the numbers that came out this week. They downgraded their guidance. If I think investors or shareholders were hoping for some relief with the departure of Deborah Crew, they certainly didn't get it. And the new interim CEO, I mean, for God's sake, just appoint the man.
Yeah. It's just going from bad to worse, isn't it? If we're being completely honest. I mean, I was looking at this earlier on. They're down 60% from the all-time highs that we saw 4 years ago. We were sort of joking around earlier. Every time you look, the stock's taken another leg lower, another leg lower, another leg lower. It's been one-way traffic for 2 or 3 years now. The earnings that they issued were frankly grim. They've cut their guidance. Net sales are lower. There's nothing to like whatsoever. And actually, I think this is getting to the point where it's raising the possibility that actually people just start coming in and bidding for brands, whether it be Guinness, whether it be some of the spirit brands, whatever it may be. And that's not going to help the long-term value of the stock either, because they're going to lose all of their prized assets. I
mean, they've got some really good brands. I mean, the share price should be a lot higher than what it is. We've got Guinness, you've got Smirnoff, you've got Johnny Walker, all really good brands. And yet, you look at the weakness in North America, the weakness in its Chinese white spirits market. There's growth in Europe, Latin America and Africa. But for me, I think Diageo is one of those companies that obviously only sells alcoholic drinks. Yeah. And, is it just people's drinking habits are changing? I mean, people are drinking less? Yeah, I think there could well be an argument for that. As you say, I don't think there's any weakness in terms of the brands that they offer, in terms of the products that they sell. If it is if it is a change in consumption habits, then that's clearly a much, much bigger problem for the company, because, that's something that is almost impossible for them to turn around. But I think, setting that to one side, if the market were to have some faith in a permanent new management team coming in who has a coherent plan to deal with what's been effectively 24 months straight of bad news, then that could provide the share price with a little bit of relief. I think at the moment it's all well and good us saying, the brands are strong. Yes, they are, but that's not enough to trigger a rally given what's going on. No, I think they need to make a decision on Nick Jengani. He's interim CEO. Well, interim suggests he's not permanent. Yeah. So, for me, there needs to be a clear line of reporting when it comes to this company. And the board need to say, right, Nick, this is your baby. What do you want us to do? What do you want the business to do? Because interim CEO tells me the board hasn't made up its mind.
Yeah.
And consequently, that means the market doesn't have confidence there's a long-term strategy in place.
Yeah, exactly. Because very quickly, as you say, interim does not suggest he's going to be there particularly long. And you cannot be pricing in a long-term strategy on the back of an interim CEO. That's just not how things work. But anyway.
Indeed. AstraZeneca, another decent set of numbers. This week, third quarter numbers. Revenue rose 11% for the third quarter. Growth across all their business areas. Once again in the news, didn't really talk about the listing structure. But I don't think they need to, do they?
No, I don't think there's anything they can say on that, to be completely honest with you at this point. It is the elephant in the room, so to speak, but it's going to remain the elephant in the room for quite some time. And actually, I don't think there's anything they can really add on that front right now.
I think there was an article earlier. There was an article in the press earlier this week. I can't remember where I saw it. It might have been The Guardian. I'm not sure, but it's about stamp duty and the fact that they've basically got an equivalent listing in the US essentially means that people now don't have to buy the UK shares. They can buy the US shares, and consequently, as a result of that, transaction volumes in the UK shares will diminish. And if other companies do that, swap their ADRs for not just primary US, just ordinary US listings, the stamp duty will go down anyway organically, because people would prefer to trade in the US listed shares as opposed to the UK ones.
Yes. And just to put into context, I read that article as well. And you gave me the first figure, which was 3 billion quid roughly, which is what we raise in stamp duty from shares. AstraZeneca contributes 200 million of that, which is insane. So, 3 or 4 others do the same thing, BP, Shell, whoever. Very quickly, your stamp duty revenue on stock purchases is gone.
Well, the 3 biggest companies in the UK are AstraZeneca, Shell, and HSBC. In terms of market cap, I think.
Yeah, you're right.
So,
they're the top 3.
And Shell has already talked about, moving its primary listing.
Yep.
So you basically you aggregate all of that in terms of stamp duty, and you probably lost almost a third of it straight away. If those 3 companies pursue a similar policy when it comes to a US listing as opposed to an ADR listing. Anyway.
Yeah, absolutely. Should we do the week ahead?
Let's do the week ahead. I mean, let's quickly zip through that. There's not an awful lot to talk about apart from my favourite company, Rolls-Royce.
We've done mine, Wetherspoons.
I only because I've been banging a drum for Rolls-Royce for about the past 2 years, and it's continued to go higher. We got third quarter GDP out of the UK, as well as obviously monthly GDP for September, I think. So there's a whole host of numbers out of the UK. We've got wages and unemployment for September as well on the 11th of November. GDP on the 13th, I think, unless that's changed.
No,
we've also got Vodafone's first half numbers, Rolls-Royce's third quarter numbers, and we've also got numbers from B&M, European Retail. Yeah, well, they issued a profits warning earlier this month, so interesting to see whether or not there's anything there. Burberry and the UK defence sector, Chemring, Kinetic, as well as Disney. So let's start with third quarter GDP. Obviously, the IMF downgraded the 2026 GDP forecast. We saw a slowdown in Q2. Are there any expectations for Q3, 0.1, 0.2?
Well, I haven't seen a consensus figure just yet. I think it might still be a little bit early, but I certainly wouldn't be expecting anything above 0.2 on a quarter-on-quarter basis. And, of course, risks to growth continue to tilt to the downside because the very back end of Q3 is going to start covering that pre-budget uncertainty that we alluded to earlier on. To be completely honest with you, I'm not entirely sure the GDP numbers are going to make much difference in the grand scheme of things. They are rather stale. The outlook is going to change considerably after the budget. expected, and the Bank of England are much more focused on inflation than growth at this point anyway. But it will nonetheless be interesting to see how the economy evolved over the summer anyway.
Yeah, I mean, there were a lot of revisions issued by the ONS recently. The most recent monthly number, and I don't set an awful lot of stock by these numbers because they can vary quite significantly. But the economy grew by 0.1% in August, apparently, but July was revised down to minus 0.1%.
Yeah.
So with the services sector flatlining for the last couple of months.
Yeah.
So
and if
September,
you think back,
yeah, go on.
Oh, I was going to say, if you think back to earlier in the year, the majority of GDP growth, I used inverted commas, was actually being driven by increased government spending.
Yeah. Exactly.
Which we can't afford.
So again, sustainability.
Yeah.
Wages and unemployment. Unemployment currently is at 4.7%, as is wage growth. So I think the Bank of England will be hoping for a further slowdown in wage growth. But I still got this. I have this nagging concern that unemployment is going to continue to head higher. Now, some of the PMIs appear to suggest that job losses are slowing, or job cuts are slowing, and that perhaps we've seen the peak when it comes to that. So maybe there's a sliver of optimism there.
I think the pace of layoffs has been slowing, but it hasn't quite yet bottomed out, and we haven't seen that flip back into a net hiring either, which is concerning. The other thing is, you mentioned wages. Well, clearly, almost 5% earnings growth is not compatible with a return to the 2% inflation target. The other issue with that is private sector wage growth continues to lag badly behind public sector wage growth. And again, that's not a sustainable manner in which we can be running the economy. So I think that's something that's worth watching very, very closely. But again, the Bank of England now expects inflation to peak at 5.1%, according to the November monetary policy report. We're already at 4.8. Feels a little bit conservative on their part, I think.
Especially when you've got chatter about this budget could raise minimum wage levels again in April. And then you've got this so-called workers' rights bills, which essentially gives new starters full employment rights from day one, which I have to say is likely to slow hiring even further. Because I'm not going to take a risk. I'm not going to take a risk on someone. On the basis that they might not be any good at their job, and then find it really difficult to get rid of them.
Yeah, and I
that's
think
the whole point of a probation period.
Yeah, and that works in both ways as well, because you might be hired and absolutely hate the job that you're doing and want to get out. The policies are increasing the monetary cost of employment, be that minimum wage or living wage, it's now called, plus, of course, the national insurance changes, but also the non-monetary cost in terms of all these day one rights, and the risk of hiring is much, much higher now, and people just aren't going to take the risk in an uncertain economic environment. This is not rocket science.
Call me old-fashioned, but when you get taken on by an employer, the employer is taking a chance on you. You then have to prove that you're worth that chance to gain those full employment rights. Sorry, I'm old-fashioned like that.
I completely agree with you.
You're not entitled to full employment rights from day one. You have to earn them. This idea of entitlement just does my head in. It's always been ingrained into me ever since I was very young that you have to earn things.
Yeah, you shouldn't just expect it to be given you.
And sometimes you get treated unfairly. That's life.
I was going to say, so be it. Life isn't fair, unfortunately. It'd be great if it was, but it ain't.
Absolutely.
Should we wrap up with Rolls-Royce?
Off my soapbox.
So Victor Meldrew has left the building.
He's just entered the building again. So Rolls-Royce. Rolls-Royce. Third quarter. Is it third quarter? Yeah, it's third quarter numbers.
It is, yeah.
Always they're still just below record highs. Another spectacular year of share price growth. I mean, I think some of the gains in the FTSE 100 have been driven primarily by companies like Rolls-Royce, AstraZeneca. A small cohort, shall we say.
I mean, we're up 92% year to date.
Yeah, exactly. I mean, I can remember when the new CEO came in and called it a burning platform. Well, he certainly lit a fire under the share price.
Yeah, absolutely. That's a terrible pun.
It is a terrible pun, but I used.
I was trying to ignore it.
I used it. But But yeah, I mean, they upgraded their cash flow, they upgraded their guidance. Full year guidance for full year. Sorry, start again. Full year operating profit guidance to be between 3.1 to $3.2 billion. I didn't bold it, so I've lost what it said.
You've lost it in your notes.
I've lost it in my notes. Yeah, so full year guidance for underlying operating profits gone up to 3.1 billion and 3.2 billion pound, and free cash flow to 3.1 billion pound. So yeah, I mean, and the company's net cash position a year ago was 475 million pound. It's now over £1 billion. So
yeah, I mean, it's going from strength to strength, isn't it?
But there has been chatter about a possible IPO of the SMR. I mean, why would you do that? Unless you're looking for help in investing in building all of these SMR reactors. So
I was going to say that would be the only thing, wouldn't it? If you want to raise capital, if you need help getting that over the line, but actually, going back to what we were saying earlier, that's what about ABF. That is one of the sort of crown jewels of the Rolls-Royce business. That's why it's traded 100% higher year to date. Don't get rid of it.
No, exactly. I mean, a lot of that share price value is as a consequence of an expectation that is going to be a very lucrative revenue earner going forward. Yeah. I mean, it's not making any money yet, and it's not generating any revenues yet, but there is an expectation that it will do by the end of this year. And when it does, you know, it's going to be a very core component of the energy mix here in the UK for quite a long time to come, I would imagine, if it's successful. Yeah. So for me, it makes no sense to IPO it.
No, I would agree. No, I was going to say I would agree. And even considering IPOing that just doesn't make sense to me.
No. But I suppose it really depends on how they raise the capital. You know, it could just be. Yeah. Rolls-Royce did say it was a fundraising exercise as opposed to an IPO. So, you know, maybe, as with anything in the press, people have sort of looked at it 2 and 2 and come up with 5.
Yeah.
Quickly do Vodafone, because obviously that's quite a decent dividend payer. Its share price has actually done okay so far year to date. There's an awful lot of optimism that the new CEO, but Margaret Delaval, since she took over, has managed to improve the financial situation of the business, and she's certainly done that. She sold off the Spanish business, she sold off the Italian business, the German business continues to be a drag, and obviously you've got the UK business in the integration of 3. So, you know, when you look at that, there is an awful lot to be optimistic about. But for me, I still think there's an awful lot of money that needs to be spent in terms of the 5G rollout plan that, you know, I don't think they've really sort of set aside a decent strategy for.
No, I was going to say that, and I think market participants are going to be looking for that strategy, and also how much is that strategy going to cost, and where's the cash going to come from?
Yeah, indeed. But anyway, okay, so yeah, dividend yield of 5%. At round about current share price. So, you know, we'll have to see how that goes. But certainly the momentum is on its side, despite the fact that we've dropped from about 94p to 87p in the last week or so. Anyway.
Yeah.
Okay, I think probably wrap this up because we've probably gone on for way too long. We'll revisit all these numbers hopefully not same time next week, hopefully Thursday afternoon next week.
Yeah.
Technical issues notwithstanding. In the meantime, thanks very much for your thoughts, Michael, and we'll talk again same time, same place next week.
Indeed. Bye for now.